All right, you know the feeling. You open your app, you see the charts, and everything is just red. Your portfolio's tanking. It literally feels like your money is just evaporating into thin air. We've all had that horrible pit in our stomach, right? So let's actually dig into this, because once you understand where the money really goes, well, it changes everything.
I mean, this is what you see on the news every single time, right? Trillions of dollars wiped out. They are so dramatic. They're designed to terrify you. And they all scream the same thing, that some huge catastrophe just hit the world's money supply.
But that's the billion-dollar question, isn't it? I mean, where did it go? Did it just poof, vanish into thin air? Did some evil genius log into the world's bank account and just hit the delete button? Or is there something way more interesting going on right under our noses? Okay, so to get to the bottom of this, you've got to totally reframe how you think about the stock market. See, it's not some giant bank vault where everyone's money is just sitting. Not at all. It's much more like a massive, kind of chaotic, super high-speed auction. And the only thing that's actually changing is the price people are willing to pay for something at any given second. Here, think of it like your house. Let's say one year, its value is $500,000. The next year, the housing market cools off a bit, and suddenly it's valued at $450,000. Now, my question to you is, did $50,000 in actual cash just disappear from your life? No way, of course not. Nothing physically left your pocket. The only thing that changed was what someone else might be willing to pay for it, the auction price. And that right there brings us to maybe the single most important idea in all of investing. It's called a paper loss. You see, when your portfolio value is down, you haven't actually lost a single cent of real money. You still own the exact same number of shares you did before. The loss is, well, it's theoretical. It's just numbers on a screen. It's on paper, for now, anyway. So here's where it gets dangerous. This is the moment that paper loss becomes a real loss. Let's walk through the steps. Okay, so you buy a stock at $100. Then, boom, the market crashes and the price is now $50. You feel sick to your stomach, but remember, it's just a paper loss. But then, the fear kicks in. You can't take it anymore, and you hit that sell button. Bam. In that exact moment, you've locked it in. You just turned a problem on a screen into a very, very real loss of $50. But here's the piece of the puzzle the scary headlines always leave out. Every transaction has two sides, right? For you to sell that stock for $50, someone, somewhere, had to be there to buy it from you at $50. So while you were panicking and clicking sell, some other person, maybe a big institution, maybe just a really smart investor, was on the other side of that trade, calmly clicking buy. And this is what reveals the true nature of a market crash. Money isn't being destroyed. It's not being burned in some giant financial bonfire. No, it's being transferred. A market crash is simply one of the biggest, fastest, and most chaotic wealth transfer events on the planet. So when it all boils down, you really have two main characters in this story. On one side, you've got the panic seller. Their mindset is pure fear. They sell their assets low and they locked in a very real loss. But on the other side, you have the patient buyer. Their mindset, opportunity. They see everything as being on sale and they scoop up those exact same assets, knowing they have huge potential down the road. It's the same event, but with two totally different mindsets and two totally different results. Let me give you another analogy. Imagine you're in a crowded room and someone yells fire. What happens? Total chaos. People panic, they scramble for the door, and in their rush, they start throwing their valuable coats and jackets on the floor just so they can run faster. Well, the few calm people who are already near the exit, they see all these valuable jackets on the ground and they just bend over and pick them up. That right there is a market crash in a nutshell. All right, I know what you might be thinking. If it's just a transfer, why does it feel so incredibly violent and destructive? Why does it feel like the entire financial system is about to just shatter? Well, the answer is in the mechanism that turns a simple price drop into a full-blown, terrifying panic. And a lot of the time, that mechanism comes down to two little words that can strike fear into any investor's heart. Margin call. See, this is what happens when people borrow money to invest. It's called buying on margin. And if the value of the stocks they bought with that borrowed money drops too far, the lender, the person who gave them the money, gets nervous. They call up and basically say, hey, you need to give us more cash right now to cover your losses, or we're going to start selling your stuff for you to make sure we get our money back. It's a forced sale. And this is what creates that horrible, vicious domino effect. You get an initial price drop, which triggers margin calls.
Those people are now forced to sell, whether they want to or not. All of that forced selling pushes prices down even further and even faster, which, you guessed it, triggers even more margin calls for other people. It's this terrifying, self-feeding downward spiral, and that's the chaos you see playing out on the news.
Let's make this real. I mean, we don't have to look back too far for the perfect case study. The 2008 financial crisis. This wasn't some abstract theory. This was the real deal, playing out for the entire world to see. When a huge bank like Lehman Brothers went under, that was the ultimate fire in a crowded room moment. I mean, just look at this chart of the S&P 500. It's just a cliff. It absolutely plummeted. If you were just a normal person checking your 401k in, say, early 2009, it looked like it had been completely wiped out. The paper losses were just staggering. Now think about this. Anybody who gave in to the panic and sold at the absolute bottom, right there in March 2009, they turned those awful paper losses into devastating, life-altering real ones. But who was on the other side of those trades? The patient buyers. They were the ones buying up everything at a massive discount, setting themselves up for what became one of the greatest bull markets in the history of the world. So this is the whole point, right here. The money wasn't destroyed in 2008. The trillions of dollars in value didn't just vanish. It was simply handed over from the panicked sellers of late 2008 to the patient buyers of early 2009. So what are the big takeaways here for you? First off, maybe stop checking your portfolio 5 times a day. That number you see, it's just today's auction price. It is not your bank balance. Number 2, tattoo this on your brain. A loss is only real if you sell. And third, and this is the big one, remember that crashes are just a huge transfer of wealth from the impatient to the patient. That moment that feels the absolute scariest, that's very often the best opportunity you'll ever get. Because look, let's be real. The next crash is coming. It's never a matter of if, it's only a matter of when. But now when you see those crazy headlines and all that red on the screen, you'll know what's actually going on beneath the surface. So the only question left to answer is, who are you going to be? The person throwing their jacket on the floor in a panic, or the person who calmly picks it up